All right. We ready there, Alex? Everything's a go? Yeah. So,
Afternoon.
good afternoon. And apologize for starting an hour later than what we had thought we were going to start, but things came up and starting at 1:15 worked a little better. So it's taped anyways, that anyone who was hoping to watch it live and couldn't, they'll still be able to watch it taped. But this is I think it's fourth?
Fourth or fifth?
Fifth taping of Consulate U. And so we've gone through the universe of investing. We've gone through supply and demand. We've gone through, what are some of the other topics that we went through? I sort of forgot them all, but they're different types of securities, stocks and bonds. We did all the education on all the different ones.
Sure.
So, but we're here today, and we're going to talk about the last article that was written on this topic, Contrarian Investor, and that's very important. And this is one reason why a lot of people just can't understand investments, because you have to be a contrarian. So, for example, when the economy is the strongest, typically is the top of the stock market, and when the economy is the weakest, tends to be the bottom of the stock market. Now that wouldn't logically make sense. You would think that when the economy is really strong, that would be the time you want to get into the stock market.
Which is what a lot of people do.
It's because
by the time it gets out to everybody, the people who aren't professionals or don't watch it all the time, they're hearing things. And so that truly is the Bernard Baruch or others that says, when your cab driver gives you a stock tip, it's time to sell the market, because market has been going well for a period of time.
Right.
And so everyone finds out about it and they say, hey, let's invest in stocks.
Sure.
And
it takes a while for that to filter down.
It takes a while for it to filter. By the time it does, there's nobody left to buy. Like that person is the last buyer. Everyone else is convinced. Anyone who can be convinced.
But now what you just said is why a lot of people think that the stock market is a casino. That you just said that when the last person comes in to buy, he's the loser. And, that's a true statement, but it's also not true, because there's plenty of other people that could come in to buy, right?
Yes.
There's tons of other people out there that still have money that could come in to buy.
Sure, but and that's at extremes.
Yeah.
That's at extremes. That's when there's, manias going on, is when that last person is in. And all that says is from a valuation standpoint. It just says they're coming in at kind of the end, if they've been on the sidelines, because we've met people who have done that. They've been out of the market. They've been very reluctant to get back in. They get back in at high valuations. Now there's no one left at that valuation to get back in. And so for the market from there, the chances are it's going to go lower in the short and intermediate term.
Right. Well, because the economy normally goes in starts and stops. Cyclical. No economy tends to go just this way and never look back again. And if it did, the market would be, a lot different. But the economy tends to go like this. And when it's making those downturns, stocks have already begun to discount well before the market starts to downturn. Markets always think ahead. Markets are not thinking when you and I have this discussion a lot. When media tells you today the market went down because, they have no clue what they're talking about, because the market has thought about those things 6 months to a year before they ever happen. Markets do not go down on a day-to-day basis because of some news thing that a media person could report.
Right. It may be a trigger, a catalyst for people who want to get out anyway, but unless there's big news, something that is a game changer.
True, that happens like 9/11. 9/11. That happens, that nobody could have expected, and it's a game changer. But normally, markets on a day-to-day basis are nothing more than a popularity contest.
Sure.
It's how many people are afraid or greedy to get back in and so forth. And the markets, is a great investor, Jim Rogers, I think, said, he said, media, you always want to know why the market went up and down. I can tell you why, because there were more buyers today than there were sellers, or there were more sellers than there were buyers. But, that's the truth. That every day it's a popularity contest. But in the long run, markets are thinking months ahead, and there's a weighing machine of good investors who are thinking what's coming in the future, and they're discounting the future before the future ever gets
even
there.
Back up a step is, well, why does this matter? I mean, if you're in it, the money you're putting in there, you don't need for 10 years or 7 years or 20 years. You leave it in there. You can't time markets. You just let it go. As long as you're going to leave it in there.
True.
It's the people that I had a conversation with somebody recently that said, hey, I'm not going to need this money for 10 years. And then he turned around and said, oh, wait a minute. Remember, I need some money in January.
Right.
It's like, well, that's a different story then.
Well, but you also have the investor, Chris, that you have that retiree that, they don't need this, all this money tomorrow, but they might need, 5% of it every year for the next 30 years of their lives.
That's the second part that we're talking, application to our clients is that exact thing.
Right. So let's get back to the issue at point, and that's the contrarian investor. The contrarian investor is somebody who goes against popular opinion, because if you follow the herd into an investment, you could be making a serious mistake. Now, let me contradict myself. If you don't follow a herd into an investment, you may be hurting yourself also. It just depends on what timing that herd is. In other words, you could have a situation like in 2009 or 10 when the market started to recover and there was a herd. Those markets were going up pretty nicely. But there was a logic behind that long-term move of the market. Whereas on the other hand, the herd, as we talked about in our article, The Contrarian Investor, 1999, we're sitting there thinking, why are these people buying Lucent Technologies at 120 times earnings? Why are they buying WorldCom at 150 times earnings? Why are they, and the list went on. And
why don't you buy a CD at 6.5%?
Absolutely. And Cisco Systems and all these other companies that were trading at these astronomical valuations, we just couldn't. Now, we could understand long term that technology was going to drive, but the valuations at the time and the amount of people that were chasing after all the same list of maybe 100 or 200 stocks was unbelievable.
Well, Nasdaq 100 went up between October of 98 and 99, went up 100%.
Right, and that's illogical or irrational. The company's earnings weren't keeping up with that kind of appreciation. And so as a contrarian investor, we said, we just can't understand it. And clients were mad at us. They were frustrated. Why aren't you buying Cisco? Why aren't you buying? And we're like,
Dell, right?
Yeah, I can't. We had mutual funds. We actually sold those things because we just couldn't understand the logic behind it. And then all of a sudden, and the other thing that was happening at that time is people were buying anything that had .com on the end of it. So chrisanddrew.com. And if it went public, no money in it, and the prospectus said that chrisanddrew.com were going to become an investment shop sometime in the future with the money it raises.
A new space. If there's a new space and you're gonna do it with the .com.
But there was nothing going on.
Even though there wasn't anything going on.
People were buying it, and they were paying astronomical amounts of money for it. And you said, this is ridiculous. This is greed driving these markets. And that's where a contrarian comes in and says, wait a minute, this isn't logical. I'm stepping back from this because it's not going to end pretty. It always ends ugly. Right. And you've seen this recently. About 2 years ago or so, blockchain became the new buzzword. Blockchain. Sure. anything to do with blockchain, which is a new technology that's the underlying algorithm behind cryptocurrencies. So we'll get to that in a second. But blockchain is the technology behind that. And so all of a sudden companies started to emerge saying, we're going to bring blockchain to the commercial world. Well, one company changed its name, and they didn't even do blockchain technology. They just changed their name to put the word blockchain into their name, and the stock went up 50% that day because of the name change. But nothing to do with the technology. Cannabis stock, a great example that people hear that cannabis stocks are going through the roof, and so they're calling us up saying, "Well, what's your cannabis idea?" And it's my cannabis idea is that I could grow cannabis in my garden. Why do we think that cannabis stocks are going to make all this amazing amount of money? It's not like alcohol. You can't make a beer or a bottle of wine or a spirit that easily.
Right.
I mean, I know there's bootleggers and so forth, but there's a whole difference between the marijuana industry. Now they say, okay, well, it's regulated and licensed, and there's only so many licenses to go out. Yeah, I understand, but if marijuana becomes legal, it becomes legal, and that means that if Drew wants to grow it in his garden, he can grow it in his garden if he wants to. He just can't sell it, right? And I just don't understand the cannabis talk unless you were the very first people in on that. You have to be very careful not to let greed drive you. In other words, why do you want to get into this? Is it because you think you're going to make a lot of money? And why are you selling? Is it because you're afraid you're going to lose a lot of money? And that's what a contrarian investor has to be thinking about is, why am I doing this? Why should I be a part of this, either on the buy side or the sell side?
Sure.
And what's the logic behind why I'm doing it? As opposed to, I hear a lot of people are making a lot of money at this.
Well, you see a lot of people doing something that can certainly be the catalyst to consider the idea, consider the investment. But that's all it should be.
Bitcoin, cryptocurrency. I mean, people were going crazy about Bitcoin, buying it all the way up to 20-some thousand a unit. But, here's the thing. Every day that they were trading Bitcoin, a new Bitcoin lookalike cryptocurrency was coming into existence. So, and everybody always said, well, there's only so many Bitcoins that can be created. Only, I think it's 22 million some odd Bitcoins that can be created. That makes them extremely valuable. But one thing to keep in mind is that a Bitcoin can be broken down into something like, I think it's 100,000, so 1/100,000th of a 22 million. And when I calculated that out, I think I came up with like two quadrillion Bitcoins or pieces of Bitcoin can be created. But then over here you have Litecoin and Ethereum and Trillium and you have hundreds of new cryptocurrencies. So, it's an infinite number of cryptocurrencies that can be created, even though there's only a certain amount of Bitcoin that can be created. So, and then you could break it down into units upon units upon units. So, I'm with Jamie Dimon on that one. I don't understand what people get so excited about Bitcoin for. I do believe in the concept of digital currency, and I understand, but I don't believe it's going to be controlled by the free market. I think it's going to be more controlled by the central banks of the world ultimately, and that's the more logical place. I'd rather have a military and a taxing authority behind my Bitcoin than just some, Winklefuss brothers. What are their names? The twins that were part of Facebook. They're the big movers and shakers behind Bitcoin, or they were.
Well, in the end, you've got to know the market.
Yeah,
you can't just know a passing piece of it. You've got to know the market. So when you see something, and I'm the one who I always liken it to traffic. To me, that's the easiest thing that I can do. You say, whenever you're driving, people are getting into your lane and people are getting out of your lane. Well, that's what people do with stocks. They see something that they like in the other stock and they go for it. And that's what makes the market go around. People are buying and selling stocks. When I see everybody getting in line and there's 3 open lines at the Fort McHenry Tunnel, I'm always looking for that smaller line. And I'm going there just by nature, contrarian. Whatever everyone else is doing, I'm going the other way. But if there's a truck that stopped at the toll over there, and there's a reason why there's only one person in line because he's blocked the road, then it's a bad decision. So that nature of doing what everyone else isn't is a good one to start with for investments, because you want to do the other thing, buy straw hats and win, or you want to do what the other people are not doing for an idea, to either go with or against something that's happening. But that's just the start of an idea.
That is true. And we talk about in this article that contrarian investors also can destroy themselves too. By John Maynard Keynes was a great economist. Came up with Keynesian economics, whether you like it or not. It's where he came. He was a brilliant economist, but he was also a very active market trader, not only in stocks and bonds, but also in commodities and other things. And he'd come up with an perfect economic theory that this was not a valid price for something, and he would either bet against it or with it, thinking that this is going to go up or down. And, weeks and months pass by, or years, and it isn't working. And he came up with the concept that markets can remain irrational longer than I can remain solvent. In other words, if you're wrong and your wealth keeps either stagnating or going down because you're wrong, even though you're going to be proven right 6 months, a year, 2 years, 3 years down the road, it's irrelevant. Your contrarian thinking doesn't help you at all. You not only have to be a contrarian thinker, but you also have to understand where's the trigger and how far are we from that trigger, forcing the market back to rational valuations. Now, we talk about this a lot, that markets can be overvalued. U.S. stock market is highly valued. Is it overvalued? We're not sure yet, but it's definitely highly valued, makes us want to be a little defensive. But we certainly aren't going to walk away from it totally, because there's no reason to believe that it's going to fall down and go down 20, 30, 40%.
It depends on which model you use. If you use the model based on interest rates as low as they are, the market is not wildly overvalued.
Right.
If you use it strictly from a PE ratio, it says historically it's highly valued.
Right. So we did have a question. We might as well answer Steve's question. It's a great question. He says, what's the difference between a contrarian investor and a diversified investor? So a contrarian investor would be somebody who's thinking, okay, technology stocks are ridiculously overvalued, even though everybody's moving that direction, and even though there's a lot of money being made there, I'm going to back away from it, because when I see that happening, I believe that it's recipe for damage to my long-term financial well-being. A contrarian is making a decision like that they don't want to be part of a popular crowd, because when that crowd decides that they're wrong and they start retreating, it's fast and it's significant downturn. So in 1999 or 2000, the NASDAQ peaked at 5,000 some odd dollars.
14th or something.
5,000, right. And then
5,028. Right.
This is the peak of that technology bubble we talked about. We had backed away from it, and then all of a sudden it dropped and it dropped and it dropped. And by the end of 2003, it went down to 1,000. 1,000. And then it started to recover.
Sure, it was on 80%. Sure.
But it took until 2017 to get back to 5,000 and break through that high that took place 17 years before. That's a contrarian investor. A diversified investor merely says, I don't know if the S&P 500 is going to be the best stock this year, or the international markets are going to be the best, or the bond market's going to be the best, or the small cap or the mid cap. But all I know is that I'm willing to accept this much of the equity market, let's call it 80%. I want 20% of my money relatively safe. That reduces some of the volatility. Or maybe I'm a really conservative investor, so I want 30% equity and 70% less volatile money. So a diversified investor first decides how much volatility they're willing to accept.
Right.
And then they diversify. So if they're a growth-oriented diversified investor, let's say 100%, we're going to pick a certain portion of U.S.-centric securities. And so I'm going to diversify between large cap, mid cap, small cap. And then I'm going to decide what percentage I want in international. And then I'm going to go with developed international, emerging market international, and maybe developed market small cap international, or something like that.
Somebody might go real estate, commodities.
And that's diversification, and everyone has to determine what they're. But a diversified investor is not worried about contrarian issues, because they feel that by being diversified, wherever a good contrarian move is, you're going to have a portion of that at all times. And so, but you're really not thinking about the contrarian issues of it. You're really just staying diversified.
In the main, you may on the edges still.
We do that.
Alter diverse levels in your diversification.
Yeah, we do that. So, for example, in our active portfolios, not in our index portfolios, but in our active portfolios, as contrarians, we'll say, like, for example, I personally don't like fossil fuels, and so I want to minimize fossil fuels on our active portfolios as much as possible. Our index portfolios, if they're in the indexes, they're just going to stay there. In our active models, we want, because the U.S. markets are at higher valuations than normal, we want a slightly lower U.S. position right now, and we want some defensive positions on the sideline that if we're right, that the markets go down from these valuations, we would have plenty of opportunity.
And one of the holdings we increased recently did this that. It's a little defensive, and it was in 40% in international.
Yeah. So we add some international because there's a contrarian bet going on. The international markets have underperformed the U.S. markets for the last, I think, 6 years now. It's a good 6-year underperformance by international markets. So the contrarian is going to say, I want my diversified portfolio to be slightly impacted over here because of that contrarian bet.
For instance, they called the 2000 to 2009 the lost decade for the U.S. large cap.
Yeah.
It was the lowest returning asset class during that decade.
Right, during the last decade.
Yeah, not during this decade that we're in, the decade before.
Right, the large cap. So here the U.S. large caps are catching up for the decade before.
Correct.
But, a lot of investors have to know that history before they get carried away in thinking that the U.S. large cap is the only place to be. Look how much money I've been making for the last 5 years. And so that's how that herd gets rolling. Nobody wanted to be in the S&P 500 in 2005, 6, and 7.
Right.
They thought it was a dead class of stocks, basically. They wanted to be in China, and they wanted to be in Europe, and they wanted to be in small cap. And then, finally along comes 2012, basically, and slowly but surely, large caps started to take off, and off they went. So Contrarian Investor, one great book before we sort of wrap this up, Manias, Panics, and Crashes by Charles Kindleberger was a great book that we read years ago, to understand.
And just as you're saying it, Steve followed up and says, so part of your diversity could be contrarian. So
which is what we were saying earlier, is that, you're diversifying, but then you're adding a contrarian component to it if you're an active index investor, an active diversified investor. An index investor is not going to do any contrarian thinking at all.
At all, versus you take somebody who was named, I think the only person who was named by Morningstar to be manager of the year for a bond fund and a stock fund was Bob Rodriguez,
Yep.
FPA.
Right.
And so he did that in the 90s. And so sometime, I don't know, about 4 or 5 years ago, he's decided the central bank is manipulating things so terribly, I'm getting out of the market. And he's been out of the market. Now he's buying real assets. So he's completely contrarian because what he sees.
And he's been wrong for 5 years.
He's been wrong for 5 years.
But will he be right in the future?
As long as he stays with his concept over the long haul, he might be proven correct.
Right. And
his approach.
And sort of wrapping this whole contrarian thing up with, so Charles Kindleberger, Manias, Panics, and Crashes, a great book to read if you want to understand the psychology of markets and how they get to this place. But then also one of my favorite quotes from Jean-Marie Eviard.
You can do it with the accent?
I will. You give me a second, I'll get it. I got to stop laughing though before I get to it. But we
were interviewing on the radio.
He started to buy gold. He started to buy gold in a gold mutual fund in like 1995 because he felt that gold was coming to an end of a 12-year bear market, a devastating bear market. Went from $850 an ounce all the way down to $225 an ounce. And he thought it was coming to an end. And it, was percolating a little, but nothing was really going on for a good 4 years. And we interviewed him on the radio. And he says to me, Drew, he says, I may be right, but 5 years is a very long time to look stupid.
That's right.
And
that's pretty good.
And he was right. Gold took off in the end. And it went from 225 to 1900. And now it's backed off again. It's sitting at about 1,400, 1,300 right now, somewhere in that ballpark. And so he was right, but it took 4 or 5 years to hold to his.
Before he got any kind of movement.
Yeah. So, contrarian investors, the dark side of it is that you better make sure that you're analyzing what you're thinking about because you could be wrong. Like you say, Bob Rodriguez sitting out of the market. I mean, Joe Granville called the bear market of 1980 and 1990 for 20-some years. It never happened, Yeah. So, you can.
And right now, Jim Rogers is calling. He's been calling for Armageddon for a long time.
He's been calling for Armageddon since 1986, the first time he was in the Barron's Roundtable. Yeah. I've listened to him, and and he has lots of great ideas. I mean, he predicted the China bull market in 2000 and in 2000 when everyone else was running for cover from the U.S. Fallout and nobody thought China had anything to do with anything. And the explosion of commodity prices, he was calling for that. But at the same time, he was also calling for the Armageddon of the U.S. financial system. So, contrarian investor can have lots of contrarian ideas. But you better make sure that if you're betting on them, you know how to close them when you're wrong, and you know how to make them such that if you are wrong, they don't hurt you much. But if you're right, they will provide oomph to the portfolio enough. And so, contrarian concept is incredibly important to an investor, unless you're just going to be a pure passive investor and you're going to rebalance your portfolio and say, I'm not even going to worry about it. I'm just going to believe the economic process of the world is just going higher. And when it goes down, I'm just going to live through it. No big deal. But there's not a lot of people that like to do that. They want to believe that you're trying to hold them back from those really bad market moves. You're never going to.
The inner nature of it says we want to be 100% in when the markets are going up and 0% in when the markets
every day
are going down. That's human nature.
That is human nature, and it's not going to work. It never works.
Nope.
Never has worked.
Nope.
But what you can do is you can make these contrarian bets to try to add alpha to your portfolio, but you should never make contrarian bets where if you're wrong, it's like John Maynard Keynes said, they make you insolvent, while the rest of the world is, in your mind, irrational.
Sure.
So,
yep.
Anyway, Contrarian Investor, great topic. You need to learn it if you want to be a great investor. This is Drew Tignanelli saying God bless.